Hello, everyone. Welcome to Construction Technology Podcast. I'm Luigi, CEO at Provision. I'm joined by my two fabulous co-hosts, Andrew from Join and Mike from Build Vision. Gentlemen, how are you?
What's up? Happy Friday.
Friday. Okay, the first topic is Mike, kick us off.
Yeah. So our friends over at Bricks and Bytes had Joe on from A16Z this week after he posted an article I think everyone's read around the AEC world operating and building buildings and software designed in 1997. So the perspectives that he brings up, there's obviously good points, but I think it misses the focal point of the value creation chain that's in the AEC space. Their critique of AEC software has fractal problems, but the real issues is that it's economic. And in the short run, I can help engineering firms capture value from engineering labor or from engineer labor to software vendor revenue. But in the long run, the productivity gains flow to the owner. And at no point does the engineering firm itself come out ahead. So the same pie on a job gets sliced up differently. And this whole visual is very eye-opening of how the market is, how software companies are going to market, how the actual general contractor, subcontractor, AE firms are going to market. And the core argument and pushback that I would have is in simple math, let's say we have a dollar construction spend for a commercial project, roughly 8 to 10 cents or 8 to 10% of that is architect and engineering services, let's say 9%, and then around 3% of that is 3% of the 9% is actual tech spend. So that AEC software industry that the A16Z report is referencing is companies like Autodesk, Procore, Nemetschek. They completely missed Bentley, which is a $1 billion revenue company, which is interesting. And every other AI native entrant into this market is kind of fighting over that really 0.27% of every construction dollar just for the AEC side. This is not construction side. This is not that side. So that's one data point. And then you see, revenue has been growing 20% year over year. Revit inside of Autodesk revenue structure is not $3 billion. Autodesk revenue for AEOC, which is Revit, BIM 360, Forma, Pipe Building Connect, all the consolidated companies is 3 billion. So you'd assume maybe 1 billion of that is Revit. So software is growing at least 4 times faster than the industry it sells into. The gap has to close somewhere. And because owners set AE fees, it closes the fee structures that AE firms can actually build. And the only way AEs can then increase their revenue is reducing labor cost. Because the owner is not going to increase their fee. They're not going to pay 12% for design services as opposed to 10% just because a customer is using AI. So net in the short run, software vendors capture value from engineering labor. In the long run, the fee compression passes the productivity gains to owners on the next contract cycle. The engineering firm is squeezed on both ends and never catches the upside. So the real value creation is what we just were talking about before, is schedule rework, O&M, operations and maintenance, building performance, procurement, which is focusing on that other 91 cents. So it's just interesting. Again, overall net, I think that the article misses the perspective. And to that point, all right, you have $3 billion of AE tech spend right now. The majority of it already that concentrated in tooling that is embedded and taught in grade school. You learn Revit in college as an engineer. To replace that $3 billion because it's not growing while Autodesk revenue is growing seems like an insurmountable mountain to climb. And I would completely push back that there's that much value to be created in the AE space, specifically around software, outside of the big foundational players. Construction as a whole is completely different. I know us three are all on the construction side. But that was my biggest takeaway from that argument, that I think it completely misses the point on where to allocate venture capital dollars in the AEC space.
Well, if you're only looking at software spend, maybe the answer is yes. But if you're looking at labor, the answer is no.
So yeah, so the pushback on that is that then goes to you're already seeing so you look at the big engineering firms are growing revenue, but their margins not increasing. So WSP, HKS, Stantec are all publicly traded, so you can see that information. And what they've been doing is they've been acqui-hiring companies to build that revenue, but their margin's not increasing. So there's been no actual report of reduction in labor across any of this tooling. And then at the end of the day, like you still have to have an engineer stamp it. You still have the insurance process and the litigation and the quality control process owned. So it's not a 5 to 10x improvement. Maybe it's a 2x improvement, but that's still not venture return value. And Autodesk, I think the biggest pushback is like construction's growing whatever it is, 3 to 5% a year. Autodesk revenue is growing 20% a year. Bentley revenue is growing 20% a year. Procore's revenue is growing 20% a year. So you're seeing them continue to eat into that 3% of an AE firm while you're trying to reduce labor. And if labor only is increased, like say you can do 2 times as many projects, I think those other lines catch up faster than opportunity to create another $1 billion revenue company. I'm not saying that there's not opportunities for $10, $20 million a year revenue companies. It's the other $1 billion company that needs to be successful, that needs to be IPOable.
So 3 things come to mind. One, you're assuming that growth is coming from the Revit side when it's probably coming from the construction side. And so I think that's the number. Maybe that's part of part of the issue.
The way
do you know?
Having insider information on how Autodesk sells, they increase the token price of Revit every year. And that's where revenue growth is coming from.
So 20% growth is coming on the Revit side. And so then you're saying if they're passing that cost is effectively a pass through. Oh, it's not pass through. So then you're eroding the fee for AE firms. That's what you're saying. Okay.
Correct. Yes. Well, and we're seeing so you're seeing these articles. Probably 5 years ago, a group of architects in the EU wrote an article about just like this increased tech fee with no value, because the whole business model of how Autodesk is successful is like, hey, you're going into Chuck E. Cheese and you got a bucket of quarters, and every machine at Chuck E. Cheese or the arcade is a different tool in Autodesk's tool belt. So you have Revit, you have BIM 360, you have Building Connected, you have Pipe. And each one of those per day costs a different amount of tokens. So I go in, and then every year, every EBA renewal or enterprise business agreement renewal, the cost per machine goes up. And that's where there's friction in the market. And again, because they have and it's just the same thing on Bentley, it's the same thing on Imagech, it's the same thing on like all these other AEC tools. It's fascinating. I'm not saying there's a clear answer, but I just don't know how that model fixes.
I don't know any structural reason why, similar to legal, you can't massively reduce the cost of your labor. I mean, everyone's thesis in venture capital right now is like A is coming for services and labor. And again, there's nothing that says that this can't be done. Similar to legal, you still want somebody who's going to be, who's passed the bar, somebody who has, you don't want to have counterparty risk. You want to be able to sue them if they do a bad job. Similarly in construction, or at least in architecture and engineering, you want them to be licensed, accredited. You want them to stand behind their work. You want to be able to go after their seal if they do a bad job. This is a company out of my lead investor's portfolio, Cedar Build.
Nice.
Oh, do you know them? So they basically have just taken a cookie cutter approach to architectural projects and only do one type of project. I believe it's mid-rise commercial. So let me go back here. The service offering is we are basically going to do they only work in Texas, and all they're going to do is help you get permit approval for, I believe it's residential. Yeah, so multifamily residential, that's all they do. You can see this stacking on various types of projects though, right? So they'll AI enable the site review, they'll AI enable the preliminary design, et cetera, until they squeeze every dollar out of that labor as much as possible. If you do this across many asset types and you do this across many configurations, I don't see why this can't be venture scale.
This could be. The software tools that sell into this.
This is different, yeah.
Much more questionable.
This is a software tool
for existing A&E firms to make the leap to this sort of business model. Like they're all.
This is a software tool. This is a software tool. Everything that's in the back end are tools, and you could have.
So in this example, like WSP with their 10,000 employees is not rolling out this tool across their organization to get to 5,000 employees.
No, they probably won't very quickly. But if someone's gaining market share in a segment that they're participating in, they might have to. It's the exact same conversation in legal. And I'm not debating that it's going to be easy. I don't know. I don't think that's the case. But it's possible that with efficiency gains, let's say through permitting, reduction in costs, let's say through expedited permitting, the reduction in costs, let's say through reduced regulation, maybe there's more competition in construction because they're more profitable. There could be a surge in demand for projects, which could mean like that case is still possible. And I'll take the opposite side of this conversation. I don't know if it's necessarily doom and gloom, but they definitely need to invest in labor replacement and productivity, and they have to hope that there's a surge in demand.
It's fun. It's like the macro lens of that is, will the surge in demand come? And we're seeing like 3 to 5% growth in construction annually right now. I would say 10% of that growth is data centers, and negative 5% of that growth is everything else. So the net out is 5% growth year over year. So now you're in this pie, like you're grabbing a portion, you're grabbing a slice of a pie that's shrinking in that example.
I mean, AIA billing indexes, have they crossed 50 in the last 3 years? Like they're down and down and down.
What's this? What's this, Andrew?
The AIA
American Institute
partnership with Deltek, I got it. I'll pull it up here. They do a billing index where they survey a bunch of firms, large firms and small firms, and I haven't signed in to have access, but it's like asking, are you billing more or less than you were in the last reporting period? I believe is like the key one, and like this is the headline. It approaches growth, and I don't think it's been above. I don't remember the last time it was above 50.
So sorry, that's if it was above.
If it's at 100, everybody is growing.
I see.
If it's at 0, everybody is
Everyone's
shrinking.
losing.
If it's at 50, I believe you're about flat.
And this is just per firm, not weighted by.
I think it's dollar weighted, but I couldn't say if it's below 50, people aren't growing.
What do you take from this? So like 1 out of 2 firms are not growing their revenue. So basically half of the industry is flat.
Yeah, it's at this point it's flat. When it's down, when it hangs out at 40 for 2 years against a backdrop of over that time 10 to 15% growth in the construction industry overall, you have to say that the pie is growing, but the slice that is going to these fees is shrinking. I don't know how you're going to extract enough blood from the stone to support the next $1 billion AEC technology company. I mean, we started in this industry, actually. First Products all went to market with A&Es, and it's tough. Like these firms are set up as like law firms. You hire a lot of junior people, you work them really hard, you bill hourly, like you advance by making partner and bringing in work and having client relationships, not by improving the firm overall. It's like very difficult inside of an A&E firm to compound like value creation. Like it literally walks out the door every day. Like there would be all these like famous international firms who would turn out there was the one guy who was really good at something, and when he would leave, the whole firm would get worse at that and they would never get better at it again. Like, which is like, right, in a software company, that's insane, right? Like we would have taken that knowledge and like turned it into a software artifact and like, oh yeah, I mean, someone left, but like we can keep running all the code, like the database still works. So, I mean, I agree. I think Revit has like a deep moat. The moat is not the technology. The moat is the training that's happened around it and the distribution that exists into the market. That like everybody learned it in grade school and knows it because the fundamental task is very complicated, and there's not a ton of budget. And I think all the BIM 2.0 companies should be selling to contractors instead of A&E firms.
Mike, you want to walk us through this?
Yeah, so I pulled together this, and I'll share this after. So this was my deep Claude design work. So this is getting back to that 27 basis points that we chatted about earlier, like that structure down from the AE's fee being 9% to the tech fee of the AE's fee being 3%, which is 20 basis point. I think the miss here is this is really just AE, not C. So every dollar of construction spent, every dollar spent on construction, 27 basis points hits tech spend. This entire pie is like where Autodesk, Bentley, Procore, Nemetschek, and these other tools are entering. So to Steelman, A16Z's position, like there's obviously capacity constraints in the MEP space for data centers, where this is where you're seeing companies like Jacob just own the entire process. So Jacobs is a massive data center designer, builder, procurer, APC. Their three vector framework is compelling. This is like replacing Revit spend, net new softwares, or reducing or providing additional services. And the problem, this is where it breaks down, which I think is very, very interesting, is like construction growth is this 3 to 5% like we talked about. Autodesk growth is 20%. That's the same with Bentley. So there's like this ratio of revenue growing into this already small. The revenue growth of Autodesk, these big entrenched players, is 4 times larger than the growth of the industry.
But A16Z probably also has blog posts talking about how low technology penetration is into AEC relative.
I don't know where the money comes from. So if you look at this, so this is where like, right, like, hey, like here's the breakdown. This is the Dell Tech report that pulls out like where the P&L is for an AE firm. So like you're living in this tech software spend. I would say out of the gate, points of that are already Microsoft, which will not be replaced. That's your like, hey, I run my business on this. So like take a half line and say like, where does that 3%? So that 3% of the 9% that we talked about, the 27 bips, does that ever grow to 10%, 5%? And the positioning here is that the only value for an AE firm to become more profitable would be to reduce the labor headcount reduction, because if you're not going to reduce profit, partners aren't going to do that. You're not going to be able to increase fees to owners. So you kind of lay in this labor bucket, and then what does that do over time? It's interesting.
I mean, we saw this with Revit. There was like a brief and shining moment when Revit rolled out where project teams expected a certain number of drawings for a project, and it became radically easier to generate them, and smart firms were able to make a ton of money, and then everyone else caught up, and now we have huge stacks of drawings and nobody is any more profitable. It's interesting. Did you guys know the Case story? There have been there are these, our architecture's a big industry. There are a lot of diversified firms over time, and so there have been a lot of experiments, some of them very successful. Case was an architectural design firm. It was very technology forward. Got started the early 2000s. Everybody knew how to code. They had software engineers on staff, like very serious software engineers. And they formed a partnership with WeWork, where they offered WeWork flat fee pricing. It was dollars per square foot of design done. And WeWork loved this because they wanted predictable pricing and they wanted to be able to go fast. And it really worked for Case because it meant they now had a business structure where they were able to compound and capture the value of efficiency, right? They didn't have to move the bar on the per fee structure. They were pricing much closer to WeWork's outcome than to their cost basis. And yeah, it worked great. I mean, eventually WeWork bought Case and it formed the nucleus of WeWork's AEC technology group that now has spawned quite a number of these BIM 2.0 companies themselves. But when it's done, it can work great.
So what do we think the future of these BIM 2.0 tools are? I know it's hard to make a generalization. And then the opposite side of that question, if you're a AE firm, what do you do to expand your share of the pie?
I mean, I hope the BIM 2.0 companies spend a lot more time with contractors. I think that they are the agent of like change and adaptation inside the industry right now. I think that they are better poised to deliver the only outcome that actually matters in the industry, which is like an owner getting a building. And I think they have needs that are different from A&E needs, and that can provide a wedge where you can go in and win in a really compelling way versus Revit. And if you fast forward 10 years, there will be a lot more licensed seats like inside of GC firms than outside of, if you ask me.
And then I'll take the other side of that. I think where do AE firms turn? A good example of this is a company called Taylor Engineers they're in California. Fun correlation is the owner of this Taylor, his son is Brett Taylor, the chairman of the board of OpenAI.
The famous HBO Silicon Valley producer?
and co-founder of a company called Sierra. But anyways, what's interesting about what Taylor Engineers has done and scaled is about 10 years ago, they developed he has an ASHR blog post about this, which is like the American Society of Heating, Refrigeration, and Engineering. He saw his fee structures go down. He was dealing with big clients like Meta, and he started to procure the equipment, the mechanical systems for the project. So going back to that thesis of, hey, we have a $1 building, cents of that $1 building goes to the structural fee for the AE firms. The mechanical portion of that is smaller. He looked at, 10 to 15% of that $1 is the mechanical electrical equipment. Can I efficiently procure that better? Him being the engineer of record, understands the systems better than a mechanical subcontractor or a general contractor could. So his bet is that he could, and he did, and it becomes an additional profit stream for him as a business. Again, he's not going after his 9% AE normal fee. He's attacking revenue and profit from a different spectrum of that dollar fee structure of a project.
This is the EPC, do EPC, but in more scopes and in more projects that maybe didn't have, take on more and more of the construction scope. Yeah.
Correct.
So you're really hoping for last point on that. I think you're really hoping for a surge in demand tailwind, or else you have to really go the kind of integration route, to your point, on both Jacobs and Taylor. This is like the last data point here. I just had Claude spin up permit applications versus architecture firms and estimating firms in New York State. I mean, the only really enlightening thing here is that you can infer that around 2020 ZIRP era, interest rates go really low, permit applications go up, which is great. And actually, surprisingly, there's a decent amount more architecture and estimating. I actually expected this number to be quite flat. I thought it would be fragmented. You're right. No, but you're exactly right before. This is firms, not headcount, but there's basically no barrier to entry. You just bring you just bring over your experience from your previous firm. And so I think any increase in permitting that we experienced from low interest rates environments have basically just gone away because more firms have been spun up.
Yeah. Okay. I'll give another way to expand the business. Capturing more, integrating more of the offering is one way to do it. The other way would be to go upstream and capture more of the equity value of what is being designed.
Unpack that.
What?
Unpack that. Yeah.
So, design building, you're a developer, call it multifamily, could be anything, works really well. It's going to drive a lot of profit to the developer. If you trade, and firms do this with people that they trust, on a case-by-case basis, right? If you trade fee today for equity value in the project, where you get attached to the equity outcome, which is usually future dated, that's very attractive to owners, right? Because it means that you're risk aligned, and it means that they don't have to pay you right now. And so I don't know that I know every way that you might do this, but if you could say, okay, we can, I don't know if it solves the problem in the long run, but we can drive down our fee initially, and what I'll do is I'll say, look, I'm not going to offer you a 20% better fee. I'm going to offer you an 80% price reduction now, but I get 2% of the gross on the back end of the project. Or upon completion, we can do this. And because my cost structure now emphasizes technology investment rather than payroll that has to go out the door every day, I can make that, I can make that trade, and I can align with the longer term outcome. That would be one way.
Very similar to what M&A lawyers do.
Yeah.
Or an IPO, an IPO lawyer, if you take a company public, I'm not hey, we might charge a hold fee of $50K, but I'm getting a percent of the IPO. Interesting. Do you think there's enough risk aversion in the AE world to do that?
People do this. I've talked to people who do this. It tends to be with it's the third project we do, and it's all right, we'll plug half our fee into into the equity stack.
But that has to be that's the residential that has an IRR, not the hospital system, right? The design of the hospital system, you're not getting equity in the hospital system.
Yeah.
Of San Francisco General or whatever, right? Yeah. So it's more of where
I don't know how you do it with institutional.
The ones that are probably more debt finance that are getting IRRs. Yeah.
Inside of institutional, I don't know why they would do that. They're gonna
Yeah.
Yeah, the risk aversion is a good question. Either way, though, you're taking on new risk. You need to expand
Yeah.
the scope of your services. Sounds like often to include messy physical things, or you need to expand the scope of like the business risk that you take. And even more so than other segments of this industry, the A&E segment has like worked really hard to avoid that sort of risk.
Interesting. That's fascinating. Do you guys want to chat through like more of our side, of the GC side, the sub side of how like there's correlations here into like what GCs are doing? I have this other fun graph that I've been losing sleep over on. I had like 13 Claude researches going last night. This was aggressive. So like this is the same dynamic on the other side, which I think is like tied to like AE might be a little behind the curve on this shift. So this is Turner. Turner has 7 ancillary product businesses over the last 25 years. Net out where's my numbers? I think these ancillaries it's hard to get the numbers out because Turner is buried under Hochtief, which is buried under ACS Grupo. But the EBITDA on these 7, I think, is 2 to 3 times higher than the EBITDA on their CM fee. So this interesting perspective is if CM fee is just the cost of customer acquisition, here's where the profit center is. So as you're a general contractor or you're someone selling into the general contractor space, if CM fee is where Procore is allocated right now or to the project, if that fee goes down, that pie shrinks because of CM or fee reduction. How do you as a tech company tie to one of these 7 pillars? I know biasly like Build Vision is on this pillar number 1, but that's another thought process of here's how a company has taken this, and you're seeing this repeated across the top 25 general contractors. I did a case study that we'll publish at some point where if you were to give a point for each one of these across the top 25 commercial construction companies, Turner has 7. There's 3 general contractors that have 5. There's 10 that have 4, and then the rest are kind of spread out below of the different services that they offer. So again, they're starting to have this shift. This becomes this powerhouse. We saw this in the defense industry in the early 50s with the consolidation of hundreds of defense contractors into the big 5 prime. We're seeing the same thing happen on the contractor side. Structure.
Can you make a bet about that?
Yeah. You're
like
seeing this already, though.
How consolidated do you think it'll be? Like, okay, I guess you're saying that like EBITDA is concentrating quickly because
Correct.
Whenever I look at ENR 400, I'm like, boy, it's as fragmented as it's always been.
But the growth, the revenue numbers, the commercial construction in place is concentrating amongst the top contractors more than ever. And you can say that's because of data centers.
Well, that is exactly what I will say.
It is,
but what that does is the other. But in that world, as you play that out over 5 years, in the K-shaped economy where data centers are the 10% growth and everything else is the negative 5% growth.
Yeah, but the negative 5 is driven by the data center demand. There are only so many electricians. There are only so many construction firms. And
I think it's macro. That's macro. The market macro. There's not enough commercial construction demand outside of data centers right now.
I don't know if that's true, Mike, because even if you look at other firms, like this is all anecdotal. When I speak to people
right now because of construction costs. Sorry, Luigi, I don't mean to talk over you.
No. I think it's fine. It adds to the conversation. But like every time I talk to a general contractor, they are busier than they've ever been. Maybe not in Canada residential, for example, but that is macro. But if I talk to a US-based contractor, they've never been busier, and it's commercial in general. I think a lot of GCs are end up going multi-sector, and if you go multi-sector,
definitely would. Because
yes, you would.
Sector will end up being highly cyclical.
And Mike, I will say I don't necessarily believe that CM fees will be squeezed because I believe that CM is being driven mostly by branding and by the client relationship. I think if you look on, let's say, like lump sum, design, bid, build, I still think that those fees are going down over and over time. And there's an argument about whether that procurement structure is going to work long term, given the quality of construction that you end up getting. But CM's a different beast.
So the pushback I'd have on CM is the people more than the brand.
I don't know about that. I don't know about that.
They want
I think it's the process.
They
Yeah.
want the Luigi that built the last hospital. They don't want provision contracting.
I want
But
So
the
what
way
it,
these, I know you would want. You'd get a good hospital. You get a level floor. But if you have, let's say, a mega hospital based firm, let's call it PCL, that does a lot of hospitals in Canada, you can't get Luigi because Luigi's tied up on a 5-year, maybe 6-year project. You get a bunch of Luigis that are informed by the PCL process. Like you can't get Luigi. Luigi's already tied up on a 6-year job.
every owner we talk to is like, yeah, I read the resumes and I talk to the project managers. Like, I might not get Luigi, the king of hospital construction in Canada, but I'm gonna get the like senior PM who did the last 2 with you and is finally ready to step up and lead the project.
and pay him a shit ton of money to do it. So I would like, I would say the memory of an organization is tied more to the people than to the processes, specifically in that hospital example. So my first job out of college was at the Eagle Stadium in Philadelphia. Turner built the stadium in 2006, 2010, whatever it was. And the Eagles wanted to do a renovation. They wanted to add more seats to actually bid on the World Cup of 2014, whatever it was. So they engaged with Turner because Turner knew the project, knew the historical project of building the Eagle Stadium, knew where everything was. And the value prop was this guy named John Zawadzniak, who has built 7 stadiums. That was his last project that he was on with Turner, and then he went out and consulted and did consulting, and he runs around and does stadiums across the country. Turner is very good at stadiums because they have a team of stadium professionals that live inside of Turner that do those stadiums. The interesting note on that is when we bid the project, Turner bid the project, they knew where bedrock was. I spent like a month in December digging micro piles in the parking lot to find bedrock and 2 feet of snow because we had no idea where bedrock was on the renovation, which was funny. But going back to that, it's like the person, the individual. And I'm starting to talk to general contractors and they're like, hey, our employees are the best asset we have. The contractors that train and upsell and upgrade their employees will be the ones that are most successful because this technology is going to be commoditized across the layer when it just becomes a people game.
Sure. I cannot deny that there's value in the individual experience at a general contracting firm. But let's say I'm PCL and there's a hospital that needs to be built in Ontario. They're not going to first look at the resumes. Let's say they want to solicit bids and go to RFQ. They're looking at the firm. They're saying, as a firm, how many hospitals have you built? What's your success story? Then they go to the resume. So I think it really is firm first. And if you were building a hospital, in Ontario and you still had, let's say you took like 3 of the best hospital builders from PCL and you created a new firm, I highly doubt the owner would take the risk with that new firm. They would go Elliston PCL because these are the hospital builders.
Okay, so what we see in the U.S. is they might not go full hospital tower with Steve's new contracting firm, but what we see in the U.S. is there are national contractors who compete in healthcare in multiple regions and potentially like across the country. In any given city, there are multiple, like major metropolitan area, there are multiple contractors who have a track record of delivering like any type of facility you want to say, including hospitals. And it's because owners know enough, especially as institutional owners, know that they want to keep multiple contractors fed. Otherwise, they will get screwed. If it ever gets to the world that only PCL Elliston can build hospitals in Canada, boy, they're gonna make a lot of money.
That is the case. That is the case.
Interesting. In the U.S., what you see is a small number of national firms that can build hospitals sort of anywhere in the country, but then in each major metropolitan area, there's usually a regional super builder or 2 who does very good work, very excellent work. Like Rudolph and Sutton, I got to take a trip to Children's Hospital of Oakland yesterday, and my son is fine, I'm glad to say. But we went by this. They're building a new tower right next to the old one, and it's Rudolph and Sutton, and they're a local firm. They're a subsidiary of Tudor Perini. I think they only work in California, and they build amazing hospitals. But they don't bid the next hospital in Las Vegas, right? That's not the scope of their work. But it means that if I'm here and I'm Kaiser and I'm building the next hospital, yeah, I got McKee, yeah, I got XL, and yeah, I got Rudolph and Sutton to bid it.
It's obviously an and conversation. It's like what makes a really good GC firm? It's the people, it's the process, it's your bonding capacity. The people in the process, that's going to be your resume. But I mean, it is the case in Canada that if you want to build a new hospital, like you are going PCL LS Don. Like
Okay.
yeah. Go look in Ontario. I'd say the last 7 out of 8 were done by LS Don or PCL.
Man, I got a business idea to pitch you guys on. We're gonna get into hospital construction in Canada.
It's the easiest type.
Yeah.
Okay, next topic. Mike, did we have one more or was that it? We had software cost allocation, which we talked about, A16 article. Permit expediters. Andrew, you want to do this one or you want to do the next one? Or the next one? Okay, you guys want to call it here?
Let's do it.
All right. Thank you, everyone. Talk to you guys next week.